Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show, episode number 80. Today is May 12th. My name is Cyprian Francis, and with me, as always, AJ Brown. Good morning, AJ.
Hello, Cyprian.
How is it going? This is the AJ Brown Show, the show where we talk all things options trading and investing. I feel like this week's common theme is inflation. Inflation this, inflation that. We got some inflation data, and the market is not really sure what to do with it. What are your thoughts? What are you seeing on your end?
I mean, yeah, we could look at the economic calendar, but not much really happened there. I mean, we got our consumer price index that was on Wednesday, basically came in as expected, and it's coming down ever so slightly, but it came in as expected, so there was no surprises there. And then, of course, on Thursday we here's price index. That's wholesale inflation, right? That's the inflation that businesses pay for the supply chain and all of that good stuff. And as you can see there, that's actually dropped below expectations, and it's going way down. I mean, when you factor out food, energy, and trade services, which tend to be a little bit on the volatile side, I mean, producer price index is down at 3.4% compared to 6% not that long ago. So basically it's showing that inflation is starting to see the effects of what the Fed did last year. And that's basically what economists have been saying is like, whoa, with your actions, let some of the things that you've done take hold, because it takes anywhere from 6, 9 months, even a year from when you take an action on monetary policy for it to actually start going through the whole economy.
And we've had a few major increases, and so I think the consensus now is maybe they're going to hold, or another quarter point is what the market is guesstimating.
I mean, when you take a look at the SPX, right, and now I'm starting to look at charts because there's not much economic news this week. I mean, earnings season is just about coming to a close here. Basically, what we're seeing here is consolidation. Take a look at this pattern, Sip. This is the S&P 500, and we were having these real nice mid-duration length channels up and down. And now for the last month, or maybe last 15 trading days, remember there's only 20 trading days in a month. For the last bit, we've basically been going sideways and consolidating down. And if we look at volumes, like if I come over here and pull up the SPY, which is the ETF that represents the SPX, you can see that volumes are kind of just stammering along. There's nothing really going on. People are sitting on the sidelines. They're uncertain as to whether they should be buying or selling, whether they should be accumulating shares or distributing their shares, selling their shares. And so there's a lot of this sideways kind of consolidation. And so people are waiting around. I don't know what they're waiting for. They could be waiting for discussions on the debt ceiling, although that seems to be like Wall Street doesn't give a crap what's happening with the dysfunction in the U.S. government right now. But it could be they're waiting for the answer on, are we going to default on our debt? They could be waiting for the next answer in June on inflation decisions for monetary policy. But they're waiting for something. And as far as us investors are concerned, we just have to understand that they're waiting. And now it comes back to like a psychology experiment. Like if you put somebody in the room, even if they're the most patient person in the world, and you make them wait, right? Wait for something. Even if they're the most patient person in the world, there's going to be a point where even that person will start to get antsy. and start to freak out, because waiting is just not in our DNAs, right? Patience is not in our DNA. So you're making investors wait with the question mark over their head. I can just imagine that big giant question mark over their heads, wondering what to do next. And they're going to start getting antsy. The longer we make them wait, the longer they're going to get, when they finally do decide to do something. It's going to be drastic, and it might be on like the most littlest of news, because that's what happens when you make somebody sit still for a while. Then the littlest thing is going to get the biggest reaction, right? And so we call that the build up to a breakout pattern, and that's what I'm seeing here, the build up to a breakout pattern, Sip.
And because we are options traders, options investors, that is the focus of the strategy and your expertise and the whole trading trainer community. Looking at this consolidation here on the S&P, would we then take a look at the VIX to kind of confirm that? Would we say, hey, that the sentiment there is really, really down, or people feel at ease? Would that lure us to, well, that helps that next breakout, right? Like that helps validate that.
It does. And so the VIX is at, below mean. So the VIX is this measurement of volatility. And when we talk about volatility, we talk about tracking historical versus implied. We also track mean reversion. So when things get really calm, we expect them to then get kind of agitated after that, because that's how, again, it's all big experiment on human psychology. So right now things are really calm. So I'm watching very carefully from a broad market perspective. I'm watching that VIX, because when you make people wait initially, which is the phase we're in right now, people will be like, okay, I can be patient, and I'm going to be calm. But by watching the VIX, when we start to see the VIX spike above its mean, or even just spike off of its lows, which is where it is right now, I'm going to know that people are starting to get antsy. They want to do something. And the problem is we don't know what they want to do. We don't know whether they're going to start buying or selling. In fact, they don't even know. And anybody who says they do have like a high probability guess at which direction they're going to go, buying or selling, I would, feel very confident to say they're full of it, because that's the whole thing behind a breakout. We don't know whether it'll break out up or break out down. Pretty much the only thing we can count on is that we're setting up for a breakout, and the amplitude is going to depend on how much we make these people wait. So how long we wait. So I'll watch the VIX to see when we get that tipping point where people start to get very frustrated about waiting. But that's what we're seeing in the markets right now. And, there are option strategies we can trade, SIP, that are total about this this waiting and this pop up in the VIX. I'm thinking calendar spreads. I'm thinking straddles, strangles. It depends on what we think the directional stock price will go. But a lot of us trade premium. I mean, that's what the whole trading trainer program is about creating income on premium. And so a little warning for you investors out there, based on what's happening in the broad market, and based on the fact that what happens in the broad market almost indubitably, I can't believe I used that adverb, almost indubitably trickles down into what's happening to individual equities and ETFs due to correlation. Because of that, you need to make sure that you've got your premium sold and your protective options bought. If you're in that situation where you've got your premium sold and your protective options bought, you're fine. No matter what happens in the short to medium distant future, you're absolutely fine. Most importantly, you have that protective option in place. But if you're actually in your covering position and you're waiting for some timing in order to sell your premium and then offset the cost of that protective options with those gains, I'm telling you, you better do something. In other words, I would sooner than later either cash out of that initial covering position, or I would get some premium sold and some protection bought, because especially if that VIX spikes, like I'm looking at right on the screen, if that VIX starts to spike, you need to be prepared. And right now, the price of buying protective options is at a low. So you might consider that's the time to do it.
All right. Well, if speaking on options premium and selling premium and things of that nature, we have a lovely webinar that AJ has put together with the team where he gives you some of the shortcuts, some of the tricks, the tactics that he's been using for almost 20 years now. In terms of selling premium. We're going to go ahead and throw the link to that webinar into the chat. So if you haven't checked it out, head on over there. And if you're listening or watching and hearing some of these terms and you don't really know, or you can't, hang with the lingo, that webinar is going to be very helpful in helping explain some of these put call strategies. And then in the show here, we're going to go through some very specific examples to break that down in real time, using day of pricing, things like that. So we're going to take a little break here. If you have any tickers or any symbols that you want to see us go over, feel free to throw it into the chat. We'll be back with some soft news, AJ's pick of the week, and our speed round. So stay tuned.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. You mentioned earlier this week that we're heading out of earnings week. And this week, I think some of the headlines I saw was Disney was underperforming, and then the other big one that I saw was Google, but Google showing their new products, and I think there's a couple clips where they mentioned AI like 148 times in their
Bard.
Yeah, and so we've been big on the AI, and I think the market was pleased with that. Any other names, any other news pieces that caught your attention this week?
I mean, you can't ignore what's happening to Bed Bath and Beyond. And we talked about it in this show, I don't know, about 5 or 6 episodes ago, about how Bed Bath and Beyond was doing a last minute like Hail Mary play to sell some bonds. It looks like Bed Bath and Beyond is on the outs. They're starting to liquidate stores. They've gone bankrupt. They've gone ahead and gotten to the bankruptcy courts. Yeah, so if you're looking for some stuff that you would have bought at Bed Bath & Beyond, you better go get some of those outlet sales, because they say that they're going to recover, that they're going to restructure, but the jury's out on that. It looks like they're a dunner.
Yeah, I mean, I don't know how many stores they have, but even if that shrinks down to like 20 or so, I guess, you're still a business, but nowhere near where you were
I mean,
at your
I
peak.
have a whole drawer full of coupons that they used to send in the mail, where you get 20% off or something like that. My wife collected those. So yeah, I'm ready.
And then I keep hearing the discussion around the debt ceiling, and we've already mentioned it a few times. And so
What a joke.
it's a combination of our government and then our inability to manage our books, and then hitting this deadline. It seems like every year there's a debt ceiling issue.
Yeah, right. And a lot of people, if you do the research, this whole thing is a self-inflicted argument, right? We've got this, no other government has this thing where if you need to borrow money, that you've got to have a vote to lift, the amount that you can borrow in order to, how many treasury bills you can sell. And so it kind of comes down to, this whole, it's supposed to be just one of these things that happens. And the last, we always hear about debt ceiling. The last time it really came to this big of a hilt, I think, was under the Obama administration back in like over 10 years ago. I think it was like 12 years ago, and you guys might remember that. And it's when S&P downgraded US debt from the top of the line to like AA, and it cost almost, $1 trillion. It was like 500-600 billion dollars back then. And so it would be very expensive for not just us as taxpayers, and not just for the government, for businesses, for everybody, if this happened. Nobody believes it's going to happen. We think it's a lot of posturing. The market obviously doesn't believe it's going to happen unless this. I really doubt that this wait and see attitude that we're seeing in the markets right now has anything to do with that. They're just sure that it'll get, figured out by the time we get to a point where we can't pay our bills, which is actually in a couple of weeks, according to the Department of Treasury leader there, Janet Yellen. So I think it's a non-issue, and there's nothing that we can do about it besides, next time you're in the voting booth, vote differently. But there's nothing we can do besides be just observers. And I almost say, when I'm driving, I get pissed off at rubberneckers, because it's like, there's nothing you can do about the accident, so just keep driving so I can get to my destination. Well, same thing here. Don't be a rubbernecker. Let's just get past this. It's like not even worth our effort to think about.
And I think Janet Yellen was on Bloomberg this morning talking about it. So, the rhetoric is there. We'll see what happens.
Another bunch of talking heads.
Another topic that I am starting to see come up in the news, and it's one that we've discussed a handful of times, is the savings rate continuing to diminish. And so that's going to start to have some effects on things. And the slowdown.
Credit card usage SIP is at a all-time high. I think the last time it was gaining this much was 1996. And so people are using credit cards a lot. They're not saving as much as their money. There's a lot of money in their savings account, don't get me wrong, but they're not saving as much in the day-to-day. They're only setting aside about 5 or 4% right now, which is at an all-time low. And we're seeing a lot of retail sales at places like Dollar General and Family Dollar and Walmart go up. And we're seeing a lot of sales at like a Kohl's, and even on online retailers are going down. We're seeing promotions are at an all-time high for stuff. And so that's just kind of a hint that on the goods side of things are slowing down. I think that's what the Fed wants, right? But at the same time, services seem to be very stubborn. And with all this extra money that people are getting in their paychecks, consumerism is still at a strong all-time high, but it does look like this stuff is moderating here.
Yeah, I mean, we talked about the savings right even before the holidays. It's starting to shrink, and so if that number is trending now, I could see it having some effects. All right, let's see. We covered the retail sales. Okay, let's get into our trending topic of the week. Right, so most of the time when we're going over your strategies and premium selling, people like to think of it in terms of covered call writing, right?
Covered calls, covered puts. Yeah.
You own the stock, and then you're selling the insurance policy, right?
Mm-hmm.
But there's a counter to that, which is the selling of naked puts. And I guess so the question is, which one is better, right? Or which one do you prefer? Which one is more advantageous, selling naked puts or buying covered calls? What are your thoughts, AJ?
Well, and the scoop is, and the reason why this is the trending topic of the week is because I've been speaking at these events recently, and I've been having hecklers, right? I've been having hecklers in the crowd or on the chat, right? When for the events where I'm doing it electronically through the web. You're always having these people, and I can just imagine their voices behind their computer. What about naked puts, right? That seems to be the buzzword, right? Every kind of cycle, there's always a buzzword. It could be Forex, it could be binary options, whatever. Right now, it seems like the strategy du jour is selling naked puts, right? And so I actually do you mind if I throw a slide up on the screen that I made last night?
Hey, this is the education segment. If it helps the viewers understand, let's go.
All right, so I looked up last night after the market closed. I looked up Ford stock, right? And so I decided to make a little comparison of selling naked. By the way, that's also called selling cash secured puts, which everybody keeps asking me about. In fact, I even had a gentleman call me the other day, and he kind of was like, hey, I'm interested in being part of your program. I'm like, good. He's like, but what about selling cash secured puts? And I was almost like, ugh, it's almost like somebody takes the air right out of my sails. I'm like, what about it? And he's like, well, da 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 da. Da. And then he started to argue with me that this was the best strategy in the world. And I said, well, it's the same thing as writing a covered call. And he's like, no, it's selling cash secured puts. So if you don't mind, I'm going to run through a little scenario. So let's talk about selling a cash secured or naked put. So if I was to sell the Ford June 16th, so this is going to expire next month, $11 put, based on the closing prices yesterday, I'd make 20 cents per option share sold, right? So great. Then the next piece of that puzzle is as soon as I sell that put, my broker is going to make sure by doing a margin requirement or margin call on me, make sure that I have $11 for every option share I sold, because that's the obligation I just took on. I basically said I'm willing to pay $11 for a share of Ford if somebody exercises that. So my broker immediately locks up $11 for every option share I sold. That's part of selling a naked put. So in effect, I've got kind of a break-even price of $10.80. My broker locked up $11 per share in my account that I can't spend now because they want to make sure I have that. If I do spend it, they're going to start sending me really evil emails and maybe even shutting down my account. So I have to make sure I have that cash in there as long as I've got that naked put sold. But I did make 20 cents. So in effect, it's kind of like I'm out $10.80 right now. So if I go through the scenarios, if stocks close above $11, if the Ford stock closes on that June 16th expiration date, basically that put option that I sold will expire worthless. I don't end up with any stock shares. I keep the 20 cents per put option sold. So I basically walk away with 20 cents per put option sold. And if the stock closes below $11, well, then that option that I had gets exercised. That $11 that the broker made me set aside gets paid to the person, and I get the stock share. I still get to keep that 20 cents. So basically, I walk away with a stock, and the break-even price is $10.80 per every one of those option shares I sold. All right, so that's the scenario for a cash secured put. Now check out the covered call. So same thing, but I buy some Ford stock for $11.80 per stock share. That's how much it closed yesterday. And then get this, I write the Ford June 16th $11 call. So the only difference here is that instead of selling the put, I'm selling the call. And the call goes for $1.13 per option share, right? So basically, right now, if I buy something for $11.87 and then get $1.13 back, my break-even price is $10.74. Now, does that look familiar? My break-even price here is $10.80. My break-even price here is $10.74. It's basically the same, right? Whether you're doing a covered call or doing a covered put, when you do the transaction, your break-even price is basically the same. This is down about 6 cents, but usually it can be up or down about a dime, but it's basically the same. And check out the two scenarios. So if the stock closes above $11 on June 16th, in this case, my call option gets exercised. So I get the $11 per option share sold for the stock shares. In other words, they give me $11. I keep the $1.13. And so I wind up, because I spent $11.87, they give me $11. So I'm out 87 cents, up $1.13. I walk away with 26 cents per option share sold. So the outcome is the same, whether I sold the covered call or I sold the naked put. It's the same exact outcome if the stock closes above 97 cents. What about if the stock closes below $11? In this case, the call option expires worthless. I keep those stock shares. I keep the $1.13, and I walk away with a stock share that has a break-even price of $10.74. In other words, these two strategies are exactly the same. They're exactly the same. And so when I say, hey, listen, when you're talking about selling cash secured puts, that's the same exact thing as writing a covered call. It's because in us kind of nerd option academic speak, we call these synthetic equivalencies. It's the same thing. You're out the same amount of money. It's just done differently, but you're out the same amount of money. And in the two different scenarios, the same thing happens. They're synthetically equivalent. And so the scoop is there's a drawback to the naked cash secured put that you don't have with the covered call. The drawback is that when you sell that naked put, you immediately, the broker takes care of this $11 margin requirement on your account. Whereas when you do the covered call and you're buying a stock and then selling the call option, you can do those at two different times. They're not done at exactly the same time. They can be done at the same time. That's called a buy right. But here at Trading Trainer, we love to leg into these sideways choppy charts, right? And so we can do these at two different times. In other words, we can get a better price for the forward stock by waiting for it to be at the low of a channel. And then we can get more than this $1.13 by waiting for this option to get to the top of the channel. And by spacing out when these two transactions are doing, we basically bump up our rewards and reduce our risk to almost nothing. You can't do that with a cash secured naked put, because when you do that one transaction at exactly the same time, the bank puts the margin requirement on your account. So that's why we like doing the covered call strategy and legging in. And when you do a naked put, you can't leg in. So I would say that when it comes to selling premium, doing naked puts is really the same thing as doing a buy right covered call, and you have to understand that. And then number two, because you're not legging in, you're getting kind of the worst case scenario. I would use, and we've talked about this on the show all the time, I would use this naked cash secured put in a different way. I would use that when I'm trying to add a stock to my portfolio for the long term. It's a stock that I really, really love, and I want to get it at a certain price. And instead of doing a limit buy order, I'll sell a cash secured or naked put. And if I can't get it at the price I want, instead of going away empty-handed, I get to walk away with some premium. So that's how I would use this strategy. But it's really not all that when it comes to those folks that are like hecklers right now and thinking that they know a lot more than the gurus out there.
Well, I mean, you've got a pretty detailed explanation there. So, we'll make a clip of this in case the question comes up. You can get the play-by-play. The one question that I have on this breakdown is, does the stock price have anything to do with why maybe one might be, look more appealing than the other in terms of the approach?
So you're talking about like this 6 cent difference between, because on this particular example with Ford, it looks like if I was to do the buy right on the Ford example, it would be better than doing the naked put. And there's a whole options trading discipline on comparing synthetically equivalent strategies. So the beauty of options is there's never one way to do something. If you're looking to get something accomplished, there's synthetic equivalencies of the option strategy, and you can quickly evaluate, especially if you have the right trading tools, which of those particular ways to do something is going to give you this like little arbitrage benefit, like you can see here. And so you would compare those 3 or 4 strategies, and you'd say, I'm going to do the buy right covered call because I can get an additional 6 cents. That would pay for your commissions plus some. I mean, that would be the difference between some gains or not. And as far as why, I mean, there's a whole bunch of all sorts of like little variables, like the risk-free interest rate plays in, and it's just, buying and selling hype on the option that might make it a different price at the moment. But I'm telling you, when it comes to the slower type strategies like we do for setting up income, being able to leg into a transaction is really the way that we can build up reward and minimize risk, build up profit and minimize loss. And so whenever we can figure out a strategy that we can leg into, that's the one we're going to do.
All right. Well, if anybody watching, listening for the first time is maybe a little overwhelmed with what we just went over, let's go over a real life example. Let's pick a name that you like. This is going to be AJ's pick of the week, actually, and the ticker that we're going to go over, we're going to get some real life examples into the mix, is American Airlines, ticker symbol AAL, a name that we've covered in the past. We do like the airlines. They kind of check a couple of those things that we're looking for. So AJ, let's get the play-by-play of what you like in American Airlines and how we can implement some of these strategies and see if we can make some profit.
Yeah, absolutely. So American Airlines is one of those ones that it's so boring. And for people who are trying to set up an income generating solution in their portfolios by using the option strategies that I talk about, boring is where it's at. And so I wanted to feature American Airlines this time around because, listen, they're not really in the news besides the fact that they have way too much business and not enough people to they're hiring pilots, they're hiring flight attendants, they're hiring people to work on the planes. They're in a huge hiring phase, and they're hiring just about anybody. So if somebody's out of work, you might want to think about a career change into the airline industry. But besides that, they're really not in the news. And they're just kind of going side. Investors don't know whether they're bullish or bearish. There is a little bit of chop periodically. We're coming off of a bottom here. And I like to look at what I call my fast MACD indicator. And so I'm going to kind of zoom in a little bit. I'm going to look at 6 months here. And I'm getting a signal that perhaps we have found it. And so if you've already purchased shares of American Airlines, or you've purchased, another way to cover our premium sales is to use back month, deep in the money, far out in time call options. So if you did that back here about 10 or 15 trading days ago, this is probably the opportunity that you're looking for you to go ahead and sell some premium, probably at this $15 strike price. So sell some call premium. If you can make some money, in fact, let's take a look to see if we can money just on this May 19th. May 19th looks a little sparse. You're only going to walk away with about 5 cents. That might not even cover your commissions. So let's go out instead to June 16th expiration, or if you're into the weeklies, you can look at the weeklies. For June 16th, you can walk away with about 35 cents per option share. I mean, that's pretty nice on a $14 stock. So let's sell some $15 premium, and then let's buy some protection. Maybe we'll buy some protection down at the $12. So when we buy protection, we go out about 3 to 6 months. So I'm thinking September, maybe even November, but I kind of like the September. I'm going to buy this $12 put with only 62 cents per option share. And I know that as American Airlines dips down, this is actually going to appreciate in value. And so even if I never use the protective option as an insurance policy, when I get done with its usage and American Airlines then starts to go back up again, I mean, it's just like an airplane taking off and landing. When it starts to take off again, I'll sell that protective option when I don't need it anymore, and I'll probably make some money on it. So in addition to making money on selling the near term at the money premium trade, I'll make some money at rolling out my insurance. So I think I'm waiting, and I'm waiting for some volume validation that this top has been found. But I think that this is exactly the good timing for doing this. And the reason why I'm waiting, SIP, is there is a possibility that Americans might go a little higher. And so if I can sell my premium and buy my protection a little higher, I will. But I'm also paying attention to that VIX that we talked about in the beginning of the show. And if I start to see the VIX spike, I'll just sell premium and buy protection right now.
And you mentioned the 19th, and the reason for that is because what?
The reason why I'm not going to sell the 19th is because that's only really 1 week away, so 5 trading days away. And it's down to only a nickel. So if I sell it, yeah, it's only going to be in place for 5 days, but I only made a nickel. And so a lot of times the amount that my broker charges me for commissions will add up to more than a nickel. And so it's not really worth it to just sell this option for a nickel if it's my commissions are not even going to cover that profit.
And also that's because the options it's the third Friday of the month and it expires, right? So if you were looking at the play, the next option would be the one that's 4 weeks out from the 19th, right?
That's exactly right. So the one that we were just looking at would be, instead of the May 19th, we're looking at June 16th. That's the third Friday of June. And of course, there are a lot of people out there that do the weeklies. So if you take a look at the weeklies, you can see that we've got weeklies. I mean, May 26th. The May 26th might be doable. If we look at the May 26th, yeah, the May 26th has 10.5 cents of profit on it right now. So I could see doing the May 26th if you want to do it a little bit more quickly. At least 10.5 cents will cover your commissions, and it makes it worth the while.
Yeah, and American Airlines is at a nice stock price to kind of test out these strategies. Which you said at $14, something around there. So, American Airlines, AJ's pick of the week. All right, let's head into our speed round throughout the week. When AJ's doing his speaking conferences and the members only weekly webinar. He's getting names thrown at him from all over the place. And so we've picked out a couple that we're going to dig into, and we'll get AJ's feedback. And so we're going to go ahead and start off with Monty in Rochester, New York, who's interested in a company called Mr. Cooper, ticker symbol COOP. Never heard of this one. Mr. Cooper.
Mr. Cooper is a mortgage company. And so I only know that because one of my real estate properties, it was with Citigroup, and then Citigroup sold the mortgage off to Mr. Cooper. So every month I get a bill from Mr. Cooper to pay my mortgage. So I know about Mr. Cooper, but so just off soft data wise, they're a bank, right? And banks are under a lot of scrutiny right now. If you haven't been living under a rock, you know that mid-sized banks that weren't under the same sort of, rules, stress tests that the big banks were under, they have been failing. And there's a whole list of them that are right on the edge of teetering. And so there's a lot of confidence or a lack of confidence in these smaller banks. And whether this mortgage company, Mr. Cooper, is one of those particular banks or not, sadly, the whole industry is under scrutiny. And so when we're selling premium, one of the things that we try to do is we try to find symbols that are so boring that they're not in the main headlines, right? They're not the talking heads are not focusing on them as a individual company, that would be the worst, but also as an industry. And right now, banks and even these mortgage companies are under the spotlight. So that would be one reason why I might want to take a break from trading premium against a company like Mr. Cooper. Now, with all that aside, I'm taking a look over here. I am going to see if I can zoom out a little bit and look at the bigger picture, and then I'll zoom back in. So this is like the pattern that we look for. This is like the sideways choppy pattern. It's a little bit higher in price, so some of you with the smaller portfolio might get clept out, but or you might be looking for, using the option substitute. You wouldn't be buying a stock or shorting a stock to do these trades. Instead, you'll be buying either a deep in the money far out in time call option or a deep in the money far out in time put option. And it looks like we just recently got kind of a fake, right? Right here, we got a bottom signal. That's definitely not a fake, but that bottom signal was right in the middle of what we think is our sideways choppy channel. And so if we would have went to do our trade, we probably would have come to the conclusion that we wouldn't be able to get the prices we want, the prices that we plan for. So we're coming back up maybe for a double top. And so here's what I think about this. If you already got yourself into the position with some sort of initial covering trade, so in this case, you would either be shorting the stock, would have already bought some back month deep in the money put options. You're coming up for another possibility to add to that. So it's called dollar cost averaging. And so if we get another top around this $47 mark where we had it last time, you might consider shorting more stock and or buying more deep in the money far out in time back month put options, right? And then coming over here, and when you see it come down past that center zone, so probably targeting below $40, that's when you go ahead and sell your protection, or I'm sorry, sell you put premium and buy some call protection, probably with a strike price up here at about $48. So that's kind of our strategy. If on the other hand, you did the other side of the equation, you bought some of the stock or you bought some back month deep in the money far out in time call options, and you sold your premium and bought your protection up here, well, then you're going to do nothing. Just let this run. There's nothing more to do. And if you didn't get a chance, if you missed your opportunity to sell premium and buy protection, the symbol is very kindly giving you an opportunity to do that again. So I love it. I don't like that they're in the news or that the industry is in the news, but I think you're onto something. I see that we had a little fake out here, and that's okay. You just need to know how to recover from that. So if you're in the long initial covering position, you've sold some stock, bought some call options, then if you haven't yet set up your trade zone, you're getting a second chance. And if you want to, this is a better opportunity for you to get into the short position. So it's got flexibility all around, Sip.
All right. That's Monty from New York, Rochester, New York, I believe. Yep, Rochester.
Yeah, right off. I think that's off of Lake Erie or Lake Ontario. I never remember which one's which.
Well, it's your neck of the woods. I've been to Rochester once, and it was not an enjoyable experience.
Oh, Monty.
All right, moving on to oil country. Let's head over to Fairbanks, Alaska, and this is Mark interested in an energy name, Halliburton, ticker symbol HAL. Last week we mentioned that energy has been boring. It's been a boring industry. Is that the trend here?
Yeah, look at it. Halliburton is really the manufacturer behind a lot of the equipment that goes for pulling fossil fuels out of the ground. I think they do a whole bunch more, but that's their main business. They them and then Schlumberger is the company that takes the Halliburton equipment and installs it, and then they hand it over to like a BP or a Shell to run it, right? So that's kind of how that whole thing works. So Halliburton's just going sideways here. It's at a good price. I think that we're seeing a double bottom here. I haven't looked at Halliburton in a while. I might actually, based on this heads up, I might look at it moving forward. But here's what I would do. I would look to see if this is a bottom. I'm getting some fake out symbols down here on my fast MACD. So I want to wait and make sure I actually have a bottom signal that is volume validated and has, right price action. So if I've got volume validation and I've got the right price action, then I'd be interested in identifying that as a bottom. And then from that, this would be a perfect opportunity to buy some Halliburton stock. Or if that's not interesting to you, and it might be interesting to you because look, they give really nice dividends every quarter. So you might consider buying the stock and adding a dividend off of it. But in addition, we'd be in the perfect position to then, next time it's up around $35 or higher, selling some premium and buying some protective options, starting that income cycle that we do. We like to collect incomes every time there's a cycle, and ideally that's once a month. So I think you're in a good place. I think this is a smart trade. The only thing I recommend to you is wait for the good signal. Don't act on any of these fake out signals.
And that's your favorite indicator for that, called the fast MACD, which
I do like the fast MACD.
If you head on over to the YouTube channel, I'm pretty sure we have a video on there that goes into exactly how you build that fast MACD. So head on over there and check it out. Thank you for that one, Mark. You've picked a name that AJ's going to add to the watch list. So that's always something that we look forward to with these inquiries. So let's head on over to the heart of America. And this is Andy in Wichita, Kansas, interested in a name I'm not too familiar with, and that is Hecla Mining, ticker symbol HL.
Here's what I know about Hecla Mining. They're into gold and silver. They've got silver mines, and I think they've got some gold mines up in Canada now. Look, let's back out a little bit. So somebody asked me yesterday, every Thursday we have a workshop for our program participants where what we do is we actually sit down and it's a hands-on workshop. We ask people to give us the tickers that they've pre-screened, and then we go through them and we pick one that meets all of our criteria, and then we'll actually plan out our trade on that one ticker, and then everybody can take that plan and execute it if they like, right? They can do as they wish with that trade plan. And so I had somebody in the program yesterday ask, do you use a 2-year chart, a 1-year chart, a 6-month chart? What is it that makes you decide? Well, I always like to take the step back when I'm first looking at a pattern. I like to look at the pattern to get an idea of when did the sideways choppy start. And like I can look back almost 18 months, and that's looks like when it started. It looks like it started around when my little girl was born, because she just turned 18 months. And so it's been moving sideways ever since. Between about $4 and $6, by the way, is a great price. That means that it's open to just about all of us to trade because it's very inexpensive. And so now I'm going to start to build more forward to the more current. So that's my recommendation to all of you out there. Pull back before you go forward. Don't just look at the most recent trading. Always pull back and then look forward. And so when I'm now looking at the most recent, I look for at least a couple of tests of a level of support and a couple of tests of a level of resistance to see if I've got kind of a mature sideways channel that I can bank on. Looks like I got something between about $5 and around 675. And it looks like I'm coming down for a landing here to find a bottom at $5. Again, I don't want to act until I'm sure that a bottom has bound, because I don't want to act and then have it go lower than that. So let's watch $5 and let's see if it forms a bottom there. And when it does, I think it wouldn't be a bad idea to buy some of this stock. Let me see if there's a possibility for buying substitute options. So I'm going to come on over here. I'm going to go out at least 8 months. And it looks like I could go out to December, but I think I'm going to go out to January LEAP, because the LEAP has more trading on it. And you want to go pretty deep in the money. It doesn't look like I can go deep enough to get an option trading it. In this case, I think I'd just be happy enough buying the stock. And then once I've bought the stock, I'm going to allow that stock to appreciate once it comes off of the bottom. And as long as it reverses probably somewhere below $7.50, when it finds that top, that's when I'm going to set up that income trade. I'm going to sell some call premium. I'm going to buy a protective put with a strike price down here at $5, and I'm going to start the income trading where you make money on time passing by, right? And you just get paid every month like clockwork. If it decides to go higher than 750, which it did a couple of weeks ago, a couple of months ago, that's back farther than what I'm showing you, then don't worry about the premium. Just look at where it tops out at that point, sell it back, take your profit, run, move on to the next trade. So that's really my game plan for Hecla Mining. Yeah, I like it.
All right, Andy, thank you for Hecla
Thanks,
Mining. It's you got some good analysis there. All right, AJ, heading into the end of the show here. We want to give everyone a quick chance to get access to your freebies. You've got some awesome stuff inside of the Trading Trainer website. And we've got some short paper or some white papers, some courses, some videos, some indicators, a slew of tools to really get you into trading options, understanding the lingo, understanding the strategy. So we've gone ahead and thrown the link to that into the chat. So if you haven't checked it out, head on over there, sign up, get access to everything. And then heading into the week, looks like markets are down, or heading into the weekend, looks like markets are down a little bit. Heading into next week, anything we should be keeping an eye on? What is next on our radar in terms of, what's going to affect the market? What should we keep an eye on?
Well, I'm watching this VIX. I'm watching this VIX to see if any sort of spiking starts to occur. I'm looking at that VIX, and I'm looking at the S&P 500. If the S&P 500 continues to consolidate and I start to see the VIX spike, I'm going to start to think about how to protect all of my premium trades. So long as I've got premium sold and protection bought, I'm good to go through any sort of storms. But if I'm still waiting for that best timing, I'm either going to liquidate that position so that there's no fear, or I'm going to go ahead and take what premium I can get at the moment, sell what protection I can get at the moment, so that I am protected through the storm. And if the VIX does start to spike and there is a consolidation, this opens the door to a whole bunch of other types of trades, not just premium trades, but now breakout trades. So I'll be looking at things like straddles and strangles. I'll be looking at calendar type spreads, anything that is a volatility play or anything that is a directional play. I might be looking at something like that. And finally, that webinar you spoke of earlier, the one that we play all the time over and over, I think I'm going to update the examples in that webinar this weekend. So if anybody wants to check out that webinar, get a refresher on that terminology, I'm going to put in some new examples probably by about Monday or Tuesday of next week. So you can check it out and see what the most fresh examples are.
All right. And with that, we're going to go ahead and close things out. Appreciate your time, AJ. Appreciate everybody tuning in. If you've enjoyed the stream, feel free to hit that like, hit that follow, hit that subscribe button. We do appreciate it. Episode 80 in the bag. We've got 100 right around the corner.
80. Wow.
That's 80 episodes on trading options and taking advantage of options premium. So hopefully many of you have been along for the ride. If you're new, welcome. AJ, once again, appreciate your time. Everybody, thank you for tuning in. We'll see you guys next week.
All right. Take care, I should say.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.